the CLS Market Outlook for the third quarter of 2016. I'm Todd Clark. In this report, we will review how CLS portfolios performed in the second quarter of the year. Next, we'll look at our investment themes and sit down for discussions with iShares and Capstone Investments in Houston. To begin, please welcome our Chief Investment Officer, Rusty Vanneman. Rusty?
Thanks, Todd. From a global perspective, CLS portfolios performed well during the second quarter. Our belief in building risk-budgeted, globally balanced ETF portfolios to help investors succeed has been rewarded so far this year. So far, in 2016, our X-Factor theme has worked very well, and we believe it will continue to work well moving forward. The X-Factor theme has benefited portfolios by enhancing returns and managing risk. What do we mean by X-Factor? In short, we mean that we like and are emphasizing smart beta ETFs in CLS portfolios. Currently, nearly one-half of our equity assets are invested in smart beta ETFs. The industry average is just more than 20%. CLS exposure to smart beta is sharply higher than it was as recently as the beginning of the year. Last quarter, we introduced a table of data and a slide in the quarterly market outlook presentation on calendar year returns for the Big Six global equity factors. These 6 factors are those we use to analyze global equity portfolios. The slide was popular, typically after it was explained, when we presented it to clients last quarter, so we use it again this quarter. This presentation is available for download on clsinvest.com. Given the data, we at CLS believe that on balance, we should have a positive tilt towards these 6 factors in the aggregate. We might like some factors more than others depending on market conditions, but in the aggregate, we aim to have consistent exposure. I spoke earlier with CLS portfolio manager Joe Smith about how we use factor investing to enhance performance. What are some of the things we look at when it comes to favoring some factors over others?
Well, Rusty, I think that's a great question. I think, just starting out in terms of, why we think about factors, it's really consistent with, how we think about the markets from more of a risk budgeting standpoint. And so, there's, 6 big factors that we focus on within the equity context of our portfolios. Value, momentum, quality, dividend yield, minimum volatility, and small caps. And so, when we go about, thinking about which factors could be important for our portfolios or which factors are likely to represent better excess returns relative towards the market, we really start with thinking about the valuations. So are the valuations showing for a factor that factor in the market is fairly cheap, fairly valued relative towards history, or slightly overvalued? From there, we'll also think about whether or not that factor is appropriate for the current market environment or economic environment, as well as thinking about what are some of the changes in risk. And so when we put those together, that really helps to inform some of our positioning in our portfolios. But I think more importantly, also where we want to maintain our risk levels in relation to risk budgeting. Right.
Very well said. So, given all that, what right now are we currently favoring in terms of factor exposures?
Yeah, I think the biggest factor that we have been focusing on more recently has really been value. So value in itself, it's definitely been something that's lagged the market over the last couple of years. We've also seen a really big boom in terms of more growth-oriented stocks or momentum-driven stocks. Some of that's obviously gone into a little bit more of correction mode coming into 2016. And so value has really come on our radar as something that we definitely are very interested in and continue to rotate into. Outside of that, I think some of the other factors we have been emphasizing. So dividend yield, for example, is kind of another play towards value. We definitely have emphasized that, especially for more of our international exposure towards Europe and Japan. And then outside of that, we've also thought about minimum volatility as a position. We use that in a lot of different ways, but I do think the biggest piece is really in terms of kind of balancing out other risk in our portfolios.
Great. Well, a couple of those factor exposures have really helped us this year. The yield and the minimum volatility have clearly benefited our portfolios. And the value is really interesting because that is an area we've really de-emphasized in recent years, so we're starting to come back into it. So it's kind of a notable shift in our portfolios. So, well, thanks, Joe. Factor investing in smart beta is not only about performance enhancement, it is also about risk management. Earlier this quarter, I had an opportunity to sit down with Sunil Shah, a director from BlackRock in San Francisco, to discuss the importance of factor-based analysis. Regarding our X-Factor theme, today we have Sunil Shah from iShares, who is an expert on factor investing. Sunil, why do you think factor investing is so important to risk management?
I think factor investing is critical to investing today more than ever. The reality is most clients have exposure to factors that they don't know about. Factor investing, what it allows you to do is have that transparency and very deliberate way to control risk in the portfolio and seek the opportunity to enhance returns over the long term.
Excellent. We continue to believe international markets are on sale and therefore expected returns are substantially higher. We think international will outperform for several reasons. First, valuations. International markets have lagged U.S. markets by a significant margin since the 2008 financial crisis. As a result, valuations, which are often considered the best indicator for future returns, are simply far more attractive now. Related to this point, dividend yields for international markets are also higher. Higher yields abroad means investors get paid until valuations normalize again. It is also expected that earnings growth will improve faster overseas, especially in emerging markets. Lastly, many international economies are implementing loose monetary policy, while the U.S. is poised to tighten policy.
2016 has been a great year so far for diversified portfolios. Through mid-year, bonds have performed very well, and so have alternative investments, particularly commodities. After a few years of being bludgeoned, the worst stretch for commodity prices in many decades, the commodity complex is higher on the year, posting double-digit gains. Some commodities are still lower, such as cattle, copper, and some grains, but most are somewhat, if not sharply higher. The energy complex is up significantly, as are precious metals and agricultural markets such as corn, soybeans, and sugar. To discuss the impact this has had on CLS portfolios, we welcome back Rusty Vanneman.
At CLS, where we build multi-asset portfolios, we typically have some exposure to commodities. In recent years, while our exposure was typically in low single digits, the large losses in commodities provided a headwind to overall portfolio performance. Since the beginning of the year, however, we modestly added to our existing commodity positions, and that has helped performance. Moving forward, our outlook on commodities remains constructive for a variety of reasons, which include continued depressed pricing, modestly rising inflation, low if not negative global interest rates, a struggling U.S. dollar despite higher interest rates, and portfolio diversification benefits. In general, we will continue to look for opportunities to add to positions, especially on price weakness. Our exposure to bonds, the ultimate diversifying asset class, has definitely helped CLS portfolios this year. Some moves we made earlier in the year and last year have paid off, including increased exposure to high yield, inflation-linked bonds, and international bonds. Still, given the low level of interest rates and the fact that the Federal Reserve is officially set to raise short-term rates, albeit slowly, we continue to be creative in how we actively manage fixed income and diversify our equity-dominated portfolios. Actively managing fixed income is also a strong belief of the sub-advisor Capstone Investments in Houston, which we use on many of our master manager fixed income positions. CLS portfolio manager Josh Jenkins sat down with Capstone portfolio manager Victoria Fernandez on this very point.
So how active do you feel fixed income investors should be?
I'm going to answer that in two parts. First, I'm going to start with how active a portfolio manager should be, because really it's a relationship between the client and the portfolio manager and the advisor, the three of them together. On the portfolio management side, I think you have to be extremely active. Even though we mentioned earlier that fixed income is a long-term investment, most people put that outlook out there, invest in fixed income and let it sit and collect their coupons. But as a portfolio manager, you're in there daily, monitoring those issues, looking at the companies, seeing what their cash flows are. You're following that on a daily basis, along with central banks and economic reporting. All of that is very important to what happens in your portfolio. So portfolio managers should be very active. On the investor side, I actually don't think investors need to be that active as far as their fixed income allocation goes. you put that there for a reason. It's either your diversification, it's because you have cash flow needs over certain periods of time, and those coupon payments are meeting those cash flow needs. So I don't think it's something you want to go in and monitor daily. You don't day trade fixed income. It's a longer term outlook, and you can put that there and rest assured that it's going to behave the way you anticipate. So portfolio managers, yes, very active. Investors on the other side, I think monitor it, but it's not something that they have to be involved in on a daily basis.
To summarize our current fixed income exposures, CLS portfolios are still less interest rate sensitive than the overall bond market. Also, our fixed income credit quality exposure, which we primarily get through corporate bonds, remains fairly steady from quarter ago levels. At this point, we are not making any large changes to our current positioning in corporate bonds. Thanks for watching. Stay balanced.
Thank you, Rusty. That concludes our outlook for the third quarter of 2016. Our next market outlook will be this October. Also, check back with us at the beginning of each month for our monthly market review, through which we'll give timely updates on portfolio positioning and how we're specifically applying our investment themes. For all of us here, I'm Todd Clark. Thanks for watching, and thank you very much for your time and trust in CLS Investments.